Hi there, folks. Charlie Gipple, certified financial planner here. Hey, certain assets are better to die with rather than to give away to your loved ones during your life. Said another way, if you're on the receiving end, certain assets are better to be received via inheritance than to be received during that person's life. And what am I referring to here? I'm referring to stepped up cost basis. And stepped up cost basis has to do with capital gains taxation. So let me explain. Let's go back, say 10 years, and let's say I bought a property. Could be farmland, could be a piece of real estate. Heck, let's just say a stock. Let's say that I bought a stock for $100,000. Today, 10 years later, that $100,000 stock is worth $200,000. Well, $100,000 was my cost basis. Cost basis is very important because that is what the IRS says. Well, that's what Charlie put into it, and he's already paid taxes on that money, and therefore he should not have to pay on that cost basis again. He should not have to pay taxes on that cost basis again. So when it comes to taxes, the higher the cost basis, the better, right? Well, let's again fast forward 10 years, and let's say that the stock is now worth $200,000. What does that mean if I sell that stock today? Well, first of all, it was 10 years, which is a long-term capital gain, which means for most intents and purposes, 15% is what I am going to pay. Well, Charlie, but what are you going to pay it on? The $100,000 gain or the $200,000 that the stock is worth? Well, of course, I'm going to pay it on the $100,000 gain, right? Because my cost basis is excluded. And that $100,000, the gain is what I pay taxes on. So that would mean to me a $15,000 tax liability. That is a simplistic example of how capital gains taxes work. Now, let's say that I pass away with that stock without ever cashing it out and realizing the gain on that stock. Because the gains are just gains on paper, at least until you cash it out and you realize that gain, right? We all know that. But let's say that I pass away today. And let's say that tomorrow my wife receives that stock. She turns around and she sells that stock. What is her capital gains liability on that stock? Zero. It's zero. Why is that? Because at my death with this stock, she got a stepped up cost basis. You may have heard of this terminology, a stepped up cost basis. This is what that means. The market value on the date of my death. You can have alternative valuation dates, which I won't get into, but generally on the date of my death, whatever the market value was of that stock, that is now her cost basis that she effectively inherits. She sells that stock tomorrow, and guess what? She pays no capital gains taxes on it. Now, conversely, let's say that today I say, hey, honey, I want to give you this stock worth $200,000. I have $100,000 in it. It's worth double what I put in it. It's worth $200,000. And here you go. And let's say, same thing. I die today or I die tomorrow. She turns around and sells that stock then. Guess what her capital gain is? It's $15,000. Why is that? Well, because I gifted it during my lifetime, she gets a carryover of what my cost basis was, right? It is only after death where you get that stepped up cost basis, assuming I still owned it at my death, right? So the point here is when you gift away a highly appreciated asset, just know that cost basis, my original cost basis, is what carries over to her. While conversely, if I died with that asset, she gets a stepped up cost basis. Gifting is a great strategy, especially with what's going to happen in 2026. What's scheduled to happen is the estate tax exemption is going to be chopped in half. It's going to be probably 14 million or so next year, but in 2026, it's going to chop in half down to $7 million. So some folks may be thinking today, man, I need to give away some of my wealth today. Well, it is a trade-off of giving away some of that wealth and avoiding some estate taxes. And the opposite trade-off is when you give something away, that stepped up cost basis is no longer a thing that person has on that asset, right? So gifting is a great strategy, but just understand that certain things are better to just pass on after your death as an inheritance to the next generation rather than gifting it to them, because a stepped up cost basis, all else being equal, is better than a carryover of cost basis. Hope that makes sense. Let me know if you have questions in the comments below.